Most people think a bank is just a bank. It's not. The US banking system is layered. Different types of banks serve different purposes. Some handle everyday deposits, others finance billion-dollar mergers, some regulate the entire system. In this video, I'll walk through every major type of US bank, what they do, and how they fit into the overall structure. Commercial banks are the backbone of the US banking system. These are institutions like JP Morgan Chase, Bank of America, Wells Fargo, and Citi. They serve both individuals and businesses. They offer checking accounts, savings accounts, credit cards, mortgages, business loans, and lines of credit. Commercial banks take deposits from customers and use that money to issue loans. This process is called financial intermediation. The bank earns money from the spread between interest paid on deposits and interest charged on loans. Large commercial banks often operate nationally and even globally. They are heavily regulated because their stability is critical to the economy. If a major commercial bank fails, it can affect millions of people and businesses. Retail banking is the consumer-facing side of commercial banking. When you walk into a branch, open a checking account, deposit money, or apply for a credit card, you're interacting with retail banking. Retail banking focuses on individuals and small businesses. It handles daily transactions, debit cards, ATM access, and personal loans. It's the part of banking most Americans interact with regularly. Investment banks operate in a completely different area of finance. They do not focus on everyday banking services. Instead, they work with corporations, governments, and institutional investors. Their primary functions include underwriting new stock and bond issues, advising on mergers and acquisitions, restructuring companies, and trading financial securities. For example, when a company goes public through an IPO, an investment bank manages the process. Major U.S. investment banks include Goldman Sachs and Morgan Stanley. Investment banks play a key role in capital markets, helping companies raise money and investors deploy capital. Credit unions are structured differently from traditional banks. They are member-owned cooperatives. That means the customers are also the owners. Credit unions are not-for-profit institutions. Instead of maximizing profits for shareholders, they return earnings to members through better interest rates and lower fees. Many credit unions are community-based or tied to specific employers, military groups, or associations. Even though they operate similarly to commercial banks in terms of services, their ownership model changes how they distribute profits. Community banks are smaller banks that operate locally. They often focus on relationship-based banking. Community banks typically lend to small businesses, local real estate projects, and individuals within a specific region. Because they are smaller, they may have more flexibility in lending decisions compared to large national banks. They play a significant role in supporting local economies. Online banks are a newer development in the banking system. These banks operate without physical branches. Everything is handled digitally through apps and websites. Because they don't maintain expensive branch networks, their operating costs are lower. This often allows them to offer higher savings rates and lower fees. Online banks still operate under federal regulations and are typically insured by the FDIC, just like traditional banks. The Federal Reserve is the central bank of the United States. It does not provide checking accounts or consumer loans. Instead, it manages monetary policy, supervises banks, sets interest rates, and works to maintain financial stability. The Federal Reserve influences borrowing costs across the economy. When it raises or lowers interest rates, it affects mortgages, credit cards, business loans, and savings rates. It also acts as a lender of last resort, meaning it can provide emergency funding to banks during financial crises. Savings and loan associations focus primarily on residential mortgage lending. Historically, they were created to encourage home ownership. They accept savings deposits and use those funds to issue home loans. While less prominent today than in previous decades, they are still part of the broader U.S. banking structure. Finally, there are shadow banking institutions. These are financial institutions that perform bank-like functions but are not traditional banks. Examples include hedge funds, private equity firms, and certain money market funds. They provide credit and liquidity to markets, but operate under different regulatory frameworks. Shadow banking has grown significantly over the past few decades and plays an increasingly important role in global finance. That's it for today's video. Thank you for watching. Subscribe for more videos about how US banking system actually works.